Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So hopefully everyone had a great long weekend. For those in Canada, happy Canada Day. For those in the US, hopefully you had a great 4th of July weekend. I know we're a little bit later just because we're going to do the EIA show, Econ show today. EIA data obviously came out on Thursday. So in segment one for the EIA show, we're going to just talk about the crude build, the product draws, what are some of the shifts that we're seeing. And we really want to talk a bit more about the Saudi Arabian official selling prices and what does that mean and how is that adjusting? Because obviously the one that is looked at the most went up by a huge number, but then the ones that on the heavy side and the medium side actually came down by a wide margin. And we just want to tease that out and understand why. And why that's so important as some of the competition heats up a bit for some of these specific crude grades, which also would help refining margins a bit, especially on some of the heavier side. But what we want to talk about, how is that going to impact the U.S. as well as Asia? Then in segment two, we're going to talk about the holiday bump. Obviously, we got a big increase in demand, but what comes next? Like typically, you have the bump and then you go sideways. And the question is going to be, do we come back a bit? Do we stay at these levels? You know, I think that we stay at an elevated level. We come off a bit because 9.4 million barrels a day for gasoline is high. You know, as we've been saying, we think it's between that 9.1 to 9.3. So just a little bit of a move down, not a huge shift because, again, we are in summer driving season. People are going to take vacations. People are going to do things. It's just going to be at a slightly reduced rate. And it's not that we're going to lose 1 million barrels a day of demand, but more of 150, 200,000 barrels below where we are now, which is still well below the last 5 years, outside of 2021, 2020, obviously, but it actually will be below 2021, which we'll talk about in a minute. Then when we look at refined products globally, we're starting to see some of these accelerating builds, and we want to talk about where are the builds happening, because obviously middle distillate still in a very bullish spot, still having some draws, but gasoline keeps building, and that's the one that we've been talking about between that bifurcation in the market between diesel and gasoline, and we want to go through that a bit more. Is it demand destruction? And at the same time, how are flows really changing as Russia continues to push a ton of product into the market, with a large part of it obviously heading towards Asia? Now, this was, I think, a good chart to kick off on, because here you can see that money, not COVID, is the biggest travel hurdle this summer, which, I think for most, you're already seeing this, COVID is COVID what? You know, some people get COVID, they're like, now I have to sit home for 5 days, I'm going to have a cold, but that it's really started to peter out in terms of the intensity and in terms of the focus. Now it's really, what money do I have available? So here you can see, and the reason why I think this is important is because it's looking at Americans and Europeans. So couldn't afford it, 45% in the US, 41% in Europe, saving money, which again, couldn't afford it, saving money. I think I really kind of put them into the same category, because you're looking to save money because you're concerned about future affordability. And then for some, it's like, I couldn't afford it right now. So it's showing what is happening now and what's going to happen in the future, which again is just giving us the confidence that you're going to get this rollover after this. Typically we have last week was big because of the 4th of July. This week is kind of that follow on as the market rebalances, given the fairly sizable pull you get on the supply chain. And then once that catches up, that's where we think we normalize, if you will, at that 9.1 to 9.3 million when you're looking at the gasoline side. And then diesel will again come back down, just because we do have more headwinds coming when we look at global trade as well as trade in the US. Another key piece, and I wanted to throw this up here to understand the natural gas side, and we'll talk more about this in the FSC show on Friday, but the gas prices are going up again in Europe. There's more flow. We talked about this last Friday, where Russia has cut more natural gas going into Europe, which is again driving up these costs. And again, that filters down to, I'm concerned about my electricity prices. I'm concerned about prices in general. So I'm just not going to spend, or I'm going to cut on spending, especially things that aren't you're not going to cut food. You may cut the amount of food, the type of food, the more expensive stuff, but you still need to eat. You still need to do things. So, driving to Disney World is no longer an option, or at this point, Disneyland in France, or Disney Euro, I believe the name is. So, but you just give you an idea, like you're just not going to do the same things as you try to, again, tighten budgets and bring those down. Now, when we start looking at the premiums, here's, I think, two really good charts that break down where when you look at the Saudi Arabian flagship Arab Light Crude, which, again, to clients in Western Europe, here you can see just how high you've gotten those prices. So it's the highest they've ever been when you're looking at the official selling price. This is the differential above that. And we're going to talk about why they feel comfortable doing that in a minute. But Saudis cut the pricing of heavy crude to lighter oil for next month by $4. So when you look at the spread, you're seeing the spread widen because, okay, well, light crude is there. A lot of guys have light crude. It's actually driven a bit more purchases to the U.S. We've had Japan and South Korea come and pick up some additional cargoes, which is why, again, we feel confident that U.S. exports are going to maintain that 3.4 million barrels a day on that average. But when you start looking at the different pieces, so the kingdom has set the pricing of its Arab heavy and Arab medium grades at the largest discount to Arab light since 2014 for August loading cargoes to Asia. China and India are typically the major buyers of the discounted crudes coming from Russia. So this is, it's not really going to compete in the same way, but it is going to provide a certain amount of allocations. And if you start to see this shift, well, okay, now that you've done this for Asia, could some of this come back to the U.S.? Could some of it come back to Europe? Saudi Arabia is not the only OPEC producer coming under pressure from Asia's run on Russian crude. Iran has been forced to slash the cost of its already discounted oil to compete for customers in China, while Venezuela is offering its crude at a record discount. So when you look at it, Iraq has also been affected. So Russia is starting to drive down that curve, and now Iran and Venezuela are also increasing their discounts and which again is opening up an opportunity for a very healthy ARB for China, for India. But the question is going to be, how much of it do they export? And with China, and we'll talk about what China hasn't been exporting, they're hoarding this, which is, again, creating, I don't want to say an artificial tightness, because even if they were exporting at a normal clip, you would still have some tightness, just given how low storage is on the middle distillate side, not the light distillate or gasoline side, but the middle distillate side. Even if they were just throwing out and were running on under an economic model and less about more of a hoarding model, you would still have some of these pricing pressures. It just wouldn't be to the extremes we're seeing it right now. So Saudi Arabia also offered similar discounts to customers in Europe and the U.S., although most of the buyers of the heavier grades are typically in Asia. But we see that pivoting, and if you look at the U.S. and if you look at the refiners in the Gulf of Mexico or PADD 3, this is what we were talking about, of waiting for some of these countries to start to compete a bit, and this crude will find its way back into the U.S. This will be attractive, especially given the fact that the U.S. refiners need the heavier grades. We are not pulling from Venezuela. We're not pulling from Iran. Mayan crude and Mexican availability has been going down. This opens up a lot of opportunity for the U.S. to start building out some of its capacity in PADD 3 and pulling all of these through. Now, what gives them the confidence to do this? It's obviously the Brent premium to Dubai, which still remains over $12. So when you're looking at this, you're seeing these huge disconnects between where the product is, and that's why even at these elevated levels of over $9 above dated Brent, above Oman, Dubai, when you're looking at Saudi Arabia, they're still below Brent, and they're still below Brent by almost $4, anywhere between $3 and $4, depending on the day. So again, that opens up the opportunity where it's like, look, I can raise my prices and I can still compete against Europe. And then the stuff that other countries need, especially the US, I can lower that and I can still make this premium. So again, I think that you're going to continue to see this be the case as we go forward. Now, when you start looking at those crude flows, obviously Russia's seaborne crude flows bounce back in the Baltics. That's going to continue to be at these elevated levels. As we've been saying, 4.1 million is kind of the stopping point. That's the infrastructure cap, if you will, in terms of what they can do. So, between that 3.74 million is a very comfortable number that they'll be able to maintain as long as they can get boats, they can get insurance. I'm just talking about what the actual physical infrastructure can manage. They can flex it to about 4.3 million, but again, it would be that 4.1 is really that soft floor. The shift to Asia, obviously you can see just where Asia continues to come through, but it is slowing down, and it's really because China has its own issues in terms of the storage problems that they have there, because they have a lot of crude in storage. But there's also pricing, how much crude can you really purchase? And there's that timing delay. So again, we just think that Asia is going to stay at this elevated level, especially as Europe continues to slow down. That's going to buffer and pick up and send more of these crudes into the Asian continent. And this just gives you an idea of how things are shifting and how China has been increasing the Russian flows. But it puts into context why we've seen such pressure on Angola and in West Africa, why we've seen such pressure in the Congo. And again, that West African front, because everybody keeps talking about, OPEC is missing production numbers. And it's like, but they can't sell their current cargoes. So why are you producing when you can't sell what you're currently offering, which is a very reduced rate to the point of where things are at the moment? So then when you start looking at the different flows, this just came out just now. The volume of diesel and jet fuel arriving in Europe from the Middle East will continue to rise in July to the highest in more than 2 years, driven by the increase in shipments from Saudi Arabia and Kuwait, as the Middle East is shipping, just as much as they're trying to compete on the flows of crude going into the U.S. They're also going to be sending more refined product into Europe, just given how elevated those prices really are. Now we start looking at total products. Here you can see total oil and products. Deficit widened from 104.7 to 107.1, holding at the very low end of that cloud. And as we've been saying, for total oil and product stocks, we expect this to just go sideways, which again, the comps get easier as we progress through. We just don't expect a huge shift. Deficit widened on total crude stocks from 32.5 to 44.9. But you can see again, for 2022, it's just stable, it's just flat. And we expect that to continue. So when you look at the deficit's going to adjust, but not because there's a huge surge in storage. It's just the comps get easier. So again, that's where the deficit's going to narrow, but not because we're getting a huge pivot in the amount of crude in storage. It's just we're not getting the seasonal draws that we normally get. Total oil product and stockpiles, the deficit narrowed from 72.2 to 62.2. You can see it's moving in the normal rate of change. It's just obviously we're going to continue to move at this reduced rate. We're going to maintain that rate of change, but we just expect it to continue to build on the gasoline front. Distillate is getting a little bit better, but it's still very tight, and we don't see that adjusting quickly. So the gasoline side is going to be the biggest driver of fuel oil, and that's going to continue to drive us higher. Now, China issued its latest batch of fuel export quotas for the year, but total allowances are still 40% less than the same point in 2021. Personally, and again, this is just what we've seen before in my career looking at China. They overreact. So they hoard, and then 20 days after they look at this, they're like, wow, like there's a lot of product here that we need to start moving through. And we do think you're going to get this revised higher, but it's going to take time. So 5 million tons of diesel, gasoline, and jet fuel quotas were awarded. But the question is, it shouldn't be 5 million. It should be closer to 7 million. But they walk it up in steps. So they do 5 million first, see how quickly that clears, and then they'll reissue something else in terms of some preliminary notices. Because again, this is all preliminary. There's going to be more to come. And again, that's where we think there's going to be some additional capacity. Now, India's exports of gasoline and diesel are expected to slow in the coming months, back to what we talked about on Friday, where they now have the windfall tax, they have the shipping the shipping cap, and that's because they were running short internally, and they wanted to ensure they had enough internal capacity before they started exporting. So again, that if you remember, India was exporting a lot of diesel into Europe, but now this is going to take some of that out of the market. But the Middle East is filling that void, which again is going to compete in that Atlantic basin. So then when you start looking at land, when you look at land storage, the deficit widened from 80.1 to 80.8, as we've been saying, just sideways. West of Suez, deficit widened from 61.4 to 63. Again, sideways. As you can see, the other 3 years are coming down to meet us, and we're just going sideways. East of Suez, deficit narrowed from 24.8 to 22.3. So when you start looking at what could start to shift this, the CPC, Caspian Pipeline Consortium, appealed on July 11th. They're challenging the lower court's order to halt all terminal operations for 30 days due to alleged violations of oil spill prevention plans. Again, Russia's trying to pull all the levers they can to impact the crude markets, and this is happening on top of the Libyan shortfalls. So if Europe were to lose CPC and Libya at the same time as they're losing Russia, that would be a huge blow to them, which is, again, obviously Kazakhstan doesn't want it because they're making a lot of money. So they're trying to do what they can. And again, these are some of the pressure points that we're going to continue to see. And that's also pushed 2 South Korean refiners bought 6 million barrels from the U.S. Japan bought around 2 million barrels as well. And again, that's going to continue to support some of these flows from the U.S., keeping us elevated with these shifts. Floating storage, when we look at where things are, surplus narrowed from 22 to 21.1. But again, we've been saying very stable, very sideways. West of Suez, deficit widened from 2.3 to 9.3. And that was all driven by West Africa. And we'll talk about that in a minute because they did issue discounts. And because of the issues with Libya, that is pulling a lot of that stranded crude that is now pulling out of Nigeria and Angola and Congo and now flowing more into Europe and some into the U.S. Floating storage east of Suez, the surplus widened from 21.7 to 30.4. And remember what we were talking about in terms of timing delays. This is it in the east of Suez. We had a lot of flow in terms of just where things are in transit. Now it's showing up, and it's being put obviously into storage. Now in the U.S., crude stocks build it came in at 8.24 million. When we factor in the SPR, the build was only 2.39, just because we continue to sell out of the SPR. When we look at where the builds were, Pad 2 had the largest. They also had a huge spike in imports, which we called for last week. They finally appeared, which drove the build of 2.23 million. And then Pad 3, we had a build of 5.56, more because we had a slowdown on exports and we had a fairly stable imports. When you look at what is really driving that shortfall, it remains Pad 2 and Cushing. Pad 2 is 30.5 million below the 5-year, Cushing 23.8. And again, it's really locked in that Pad 2. Is Pad 3 is 10.3 million off the 5-year average, but it is skewed by 2020. So when you take out 2020, it's actually in a fairly normal place for this time of year on the coastal front, while Pad 2 and Cushing remain fairly low. So runs in the U.S. slowed down as they normally do for the July 4th weekend. This will just come back, again, nothing there's just 0.5%. So again, a lot of that was in Pad 3, still running fairly elevated from a utilization standpoint. So we don't expect to see any real shift. European gasoline exports to the U.S. remain fairly sluggish. We do think that will pick up a bit, especially that Europe now has a new seasonally adjusted record of gasoline and storage that they're going to try to manage. So then when you start looking at the utilization rates, as you can see, we're fairly normal for this time of year in comparison to the last 10 years. Obviously at the upper end, but still maintaining a fairly normal backdrop. Imports increased 840,000 barrels a day. That's still light versus the 5-year average, and Pad 2 had that big recovery, increased 828,000 barrels a day. And as we said, Pad 2 and Pad 5 were going to bounce just because of some of the seasonality. Pad 5 had an increase of 352,000 barrels a day. while pad 3 still remains slow. But it's going to be a matter of where is floating storage and where is current storage right now, which again will pull some through. And given the drop in Saudi Arabian pricing, we do think that will attract more imports into the U.S. and specifically into pad 3. So imports into pad 3, you can see there's normally this drop. You have the spike and then the fail. It's along seasonal lines. Again, it'll go back up. We still expect this to trend closer to the 5-year average and make new 2022 highs, but still be well below what should be happening at this time of year. While pad 2 had that nice spike, you can see that we normally get these elevated numbers. We still hold to the point that it's going to be above the 5-year. It's going to be towards the top end of the cloud as more product is imported into pad 2. Implied demand, this is what we were talking about here, 491,000 barrels a day of additional demand in gasoline. Not surprising given we are in the July weekend, had that long weekend, and now things start to normalize. They don't go back to 8.9 million though. They go from 8.9 to 9.4 to 9.2. So you'll get a pullback, but it's not going back to what it was because this ushers in the start of the true driving season. Obviously, driving season theoretically starts at Memorial Day. But this is, that July and August and, first 2 weeks of August, that 6-week period is really the key piece of where we get the most vacation, the most driving. So again, that will remain elevated. Distillate, there had to be some of that refill. So that 814,000 barrels a day, that falls back to 3.7 million barrels. So it went from 3.5 to 4.3, and it comes back to 3.7. Jet, same thing. You had the spike for the season. That comes back to our range that we've been talking about of 1.45, 1.55. And then propane had a drop of 527,000 barrels a day. That will rebound a bit. But again, even as demand fell in the U.S., we had an explosion of demand on the export side. So again, that's still keeping things fairly elevated. Gasoline implied demand, you get an idea of just, yes, we got that spike. It's still well below where we were in 2021 and well below where we were in 2019, 18, 17, 16. Again, you're still seeing it. We should get it. But again, it's still at a marked discount from where things were or flow from where they are normally. As we've been saying on crude oil inventories, flat sideways, and some of the comps get a bit easier. Again, that doesn't change based on where we see things. Days of supply of crude, this will come back up. This is about a little bit of a lag. Still, again, remaining in a fairly comfortable spot, just given where we are on the storage front versus the refinery runs side. But that's looking at more total crude consumption and less utilization rates, because even if we go to 100% utilization, we're still running less crude than we were 3 years ago, just because we've shuttered refiners. So again, that's going to take things down. Then when we look at total U.S. crude and refined product stocks, as we've been saying, we expect to see a gradual increase, very slight rate of change. We're not talking about this huge build, but again, we expect this to continue to grind higher as the comps get a little bit easier. You can see here from let's call it June till the end of August, you get a steady down move, and we're just saying that we're not going to get that down move. Instead, it's either going to be flat to slightly up. Again, increasing, making the comps a bit easier. Gasoline storage, fairly flat, going back the last 29 years, right at the average. We do expect this to continue, as we were saying, to grind a bit higher and really shake off what we normally see as a down move. It'll, again, be that sideways to up movement, which again will put us closer to normal, given that the comps get easier as we progress through the summer. Distillate, on the other hand, continues to be, again, the rate of change still remains up, but we had a draw. We continue to see some of this come down. And when you look at it, you can see we're still well off where we should be this time of year. The rate of change is showing that we're not closing that gap, which is going to remain a concern as we head into the winter months. And then jet fuel, again, is fairly normal, bouncing around here. Crude curve had a very big shift down, and a lot of this is pricing in a recession that's going to really be in 23 and 24. That's why you're seeing that movement down. We still see that supply-demand backdrop when you're looking at where some of these opportunities are. You know, the front month is where a lot of the retail guys can get in. They can own the first 3 months between either the USO or futures. But, you know, when you start looking at guys that are pricing stuff in, you know, that's why we're seeing some of that curve move. We do expect to see that curve recover a bit, but the recession was really getting priced in on this yellow line. Then when we start looking at crude oil inventories in PADD 3, it's the highest for 2022, and we expect that to continue. And it's clear, like when you look at the normal months, 2021, when you look at with 2017, 2018, typically you have this down move into the end of August. And we just expect that to shake off and stay elevated, again, making the comps much easier going through the rest of the year. And then Cushing continues to be fairly flat. It was a small build, but again, we expect this to creep higher a bit. Just as we get a little bit more production, we get a little bit, we still maintain exports, but as we get some additional imports, that will push some of that crude and keep it in Cushing at this point in time. Now, floating storage, you can see it dropped a bit. It's back to the lows of 2021. It's going to fluctuate back and forth, but still, again, it's going to be that timing delay as to when does it show up and when does it get pulled into the system. Now, in the next segment, we're going to go deeper into demand, deeper into U.S. refined products, and where we see things going for the rest of the summer.